This is Matthew Cratter from Trader University, and today I want to talk about when will the stock market bottom. We're seeing quite a sell-off, and a lot of people are asking me where I think the end of this is. If you're interested in learning how the economy actually works so you can make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So as you all know, we've been very light on equities really since the beginning of September, when I started talking a lot about the bearish candlestick patterns that were forming. And we really have had sort of a fulfillment of these where the S&P 500 has retraced all the way back below the 50-day moving average, sort of in free fall now. And interestingly enough, it's actually back to where it was at the beginning of the year. It's back to December 31st levels. So we've had just a tremendous amount of volatility in the SPY, the S&P 500, and have really gone nowhere. NASDAQ holding up a little bit better, but still a pretty deep retracement so far from the highs. Now, I think Dan Tapiero had a great tweet about this, where he talked about that there's not enough liquidity being added to the Fed, but added by the Fed in terms of money printing, quantitative easing, asset purchases by the Fed, and that the strength in the US dollar, the weakness in gold and Bitcoin are signs of this lack of liquidity, as well as we can say the weakness in stocks as well. This is really a manipulated market that needs constant heroin from the Fed. So if we look at gold definitely in a free fall here. Silver, which is kind of a high beta version of gold, at least this year, did really a sideways top formation and now is completely retracing everything. Interestingly enough, Bitcoin peaked before the stock market, and it has been holding fairly well here. It hasn't been hitting new lows or new monthly lows as even though stocks have been hitting new monthly lows. There's been quite a weakness as well in the FANG stocks. Google almost all the way back to the 200-day moving average. Facebook below the 50-day moving average, Amazon, etc. So breakdown in a lot of these market leaders. If we go back, Dan cites a very interesting chart by Vallee called the Liquidity Impulse, and I wasn't able to figure out this morning exactly how he's measuring this or whether it's a proprietary indicator, but it does show that in early September this impulse turned negative. We can see the zero line right here and turned negative right at the beginning of September. And we've sort of had this divergence here where the S&P peaked and is now heading down and basically following the lack of liquidity. One thing that Vallee talks about is that Treasury issuance has been much greater, has sort of accelerated, and Fed purchases have decelerated. So this creates a large negative drag to global liquidity. And then Powell's comments last week, as Vallee points out, on the fact that there's no need to increase the balance sheet. A lot of people, Dan Tapiero and Vallee, are suggesting this might be a serious policy error, that what happened is the Fed got worried about the blow off top in stocks like Tesla and tech stocks, and as a result they took their foot off the pedal and they stopped increasing their balance sheet as fast as they should be, given the deflationary forces around us of restaurants closing, but small businesses closing, people not traveling as much, etc. This is a chart of the Fed's balance sheet, and we can see that it really peaked in early June. A lot of this pullback in the assets held by the Fed. Again, the Fed prints money, buys assets, adds them to their balance sheet here. A lot of this pullback is caused by foreign central banks using sort of giving back their liquidities, their currency swaps. If we look at the amount of treasuries that the U.S. has been buying, the slope has changed. So this is treasuries held by the Fed, and we had this real acceleration up until end of April, early May, and then the slope has flattened quite a bit. So they're still buying treasuries on margin. But the fact that, I think Dan's right, the fact that gold, Bitcoin, and stocks are showing such weakness is showing that the Fed is not doing enough to prop up the markets. Unfortunately, this is the world that we live in. I'm not in favor of this kind of market manipulation, but this is the fiat system with the dollar as world reserve currency. So how low could this go? Well, I think one thing to take a look at is the strength in the dollar and where that might end. The DXY, this is basically the exchange rate for the dollar versus a bunch of other major foreign currencies, particularly the euro. When this chart moves up, it means the US dollar is strengthening. When we get big spikes in the dollar, it's very bad for the financial system. It shows stresses in the euro dollar market. And so we're well off the, obviously well off the 103 highs that we hit back in March. But we do look like we may be retracing to this congestion area of around 96 or 97. Right now, DXY at 94.53. So that suggests that the sell-off could still continue for a while. It's a little bit of a chicken and egg problem. Do stocks fall because the dollar is strengthening, or does the dollar strengthen because stocks are falling? It's a little bit of both, I would imagine. So it looks like DXY has more room to run on the upside. And I would suggest likewise for the VIX. The VIX, the last peak at the beginning of September was in the, call it 35, actually peaked around 38 on the VIX. If I scroll in a little bit here, this suggests that given the severity of this sell-off, that we should perhaps retrace back up at least to the mid 30s on the VIX, which is really the fear indicator. As well as if we look at some of the moving averages, the S&P now looks like it's really headed back, having gone back to its break-even level for the year. It's really headed back to at least the 200-day moving average, which suggests that there's a few more days or possibly weeks of pain ahead. And then what makes this really difficult to call is that we have the election coming on the horizon and all the volatility that's going to be associated with that. So this could definitely, the period normally from October, beginning of October through the beginning of May is the most bullish seasonal time for stocks. But the election, the presidential election in the U.S. really complicates matters at this point. So what I would suggest is that we do continue to sell off at least for a few weeks, unless one of two things happens. One, we really would need some sort of stimulus passed by Congress, some sort of fiscal stimulus package, which has sort of been stalled. We would need to see that. The market would like to see that. Also, what we need to see is a big Fed announcement sort of walking back the fact that they've said they're on autopilot. And if they really step up to the plate and say we're buying more junk bonds, we're buying more treasuries, we're going to get back into the quantitative easing gear, then you'll see everything move up simultaneously. You'll also see gold and silver and Bitcoin and stocks all move up simultaneously. So I think it would take one of those two triggers for it to happen. And I think that the stock market will really probably force the hand either of the Fed or of Congress. If it sells off hard enough, then they will be forced to take action. One last interesting data point was this quote from SentimenTrader, quoting a Bloomberg article which said we just saw the biggest outflows from the QQQ since the dot-com bust. Now they're measuring this in dollars. The NASDAQ was the whole QQQs were a lot smaller in terms of market cap back then. So I think that needs to be adjusted, and SentimenTrader did not adjust for that. But interesting observation that similar days with large outflows, even if this wasn't really as big on a market cap adjusted basis as the outflows from March of 2000, it does suggest that there are more losses ahead for the NASDAQ over the coming weeks. When these sentiment flows and money flows, when they reverse, it's a little bit like turning around the QE2 cruise ship. It takes a while, and then you get these sort of knock-on effects where stocks continue to sell off because they have been selling off, and more and more people's stop losses get hit, and there's really a panic. But I think I'll definitely be watching those mid 30 VIX levels. I'll be watching the 97, 96, really 97, 98 levels on the DXY, as well as obviously monitoring if Congress is going to be able to do anything in terms of fiscal stimulus this close to the election. And of course, at some point, the Fed will step in and cry uncle and say that they're getting the money printers back into high gear. If you found this video helpful, be sure to hit that subscribe and like button, hit the notification bell so you can be notified when I put out my next video. Stay safe out there. Make sure you observe your stop losses and make sure you can distinguish between what was a short-term trade, what was a long-term investment. No need to trade around long-term investments if you still have conviction in the fundamentals. Short-term trades, don't let them turn into long-term investments. Let me know your questions and comments as well in the comment section below. And thanks a lot for listening. I'll see you in the next video.